Hey everybody, this is Colin podcasting about real estate and welcome to show 36. My guest today is Mr. Mike Morawski. He's got an incredible but quite a harrowing real estate journey that he shares with us. He's a 30-year real estate veteran, started out in the late 80s and early 90s as a general contractor in Chicago, which he built up and sold to businesses was burning him out. He later formed a very successful sales agency and flipping business that was doing a couple of hundred sales a year, over 20 million in revenue. He had a huge personal portfolio of 100 plus units and was doing incredibly well for himself. But in the early 2000s, he founded a private equity group, raised millions and millions of dollars from investors and bought over 4,000 units. Apartment units across 5 different states just before the financial crash, and it ended up being a total disaster in the end for Mike, and he's very candid about the mistakes he made, what went wrong, and he ended up serving time in federal prison from it. So a very very harrowing story he's got for us. He's a lot older and wiser now, and he's learned a lot of lessons, and there's a lot of lessons in here, I think, for people about how real estate can go incredibly wrong, especially for people that are managing other people's money. That's a very different thing to managing your own money and your business partner's money. So a lot of harsh lessons here. Very interesting story. He had an incredible real estate journey from the mid 80s up to the mid 2000s before it went terribly wrong, and he's very candid about it and very open about it, and I think it meant for a really interesting conversation. So let's just head straight on over and see what Mike has to say. Mike Morawski, how are you doing? Welcome to the Colin Podcast Show.
Hey, Colin, thanks for having me. It's good to see you.
It's a pleasure. So tell us a little bit about yourself, Mike. Where did you grow up? Was your family entrepreneurial?
That's a great question. They were not entrepreneurial, and there was no real estate history in my family background at all, which is kind of interesting. I always tell a story that the first exposure I ever had to real estate was I was sitting on the side of a swimming pool with my dad. I was 8 years old. We were at a resort on vacation, and I asked my dad about all the rooms at the hotel, and he said, "Oh, people come here and they stay here, they vacation here, and they pay the owner money." And from that point on, I knew I wanted to be the owner of a big building where people paid me money. So, yeah, I had no real estate background or entrepreneurial background in my history.
So, and most of my guests don't, funnily enough. I mean, a lot of them had grandfathers that were entrepreneurial, and then it seemed to skip the generation, and then the grandchildren were had the bug as well after that. But so where did your passion for real estate come from? How did it manifest itself when you're a little older?
Yeah, so I was in the construction business and had a general contracting company in the Chicago market, and grew a pretty good sized company. We were doing about $5 million in residential rehab, kitchen and bathroom additions per year.
And take us back. When was this, to give us some context?
Early, late 80s, early 90s. 1991, I woke up one morning in 1991, looked at my wife, and I said, "I can't do this anymore. I'm tired." I was burnt out. I was still banging nails. I had a lot of things going on. And,
who were your clients? Who were you working? Who were you doing projects for?
Residential homeowners was 60% of my business. The other 40% was commercial owners. I did a lot of work in the construction business for inland real estate, equity office, equity multifamily, big apartment syndicators that were based in Chicago, and did a lot of work on those apartments. So that's where I really got the bug for real estate. I figured out how the model worked, and I studied that model, which was you raise private equity, you find a great real estate deal, you stay in the middle, and as long as things go well, everybody makes money. But so I woke up that morning and had told my wife, I said, "I can't do this anymore." We wound up selling the business and took a year off. And took a year off to decide what I was going to do, and went and did a house hacking before house hacking was famous or popular.
Before it had a name, yeah. It's been happening a long time.
couple of rehabs on a couple of two flats, and I met a really successful real estate agent who, my philosophy's always been success leaves clues. And I went to him and asked him a bunch of questions, and he gave me some guidance and direction about how to go be successful in the real estate space. Actually made me a cassette tape that's similar to these podcasts these days, right? And
I guess so, yeah.
Over and over and over again. And I went into real estate. My first 8 months in the real estate business, I sold 78 properties.
Wow.
Yeah. So.
And this is back in Chicago in kind of mid 90s?
Beginning early 90s. So 92, 91, 92.
And were these, were you selling them to homeowners, or were you selling them to local investors that wanted kind of, C or B class rentals? What kind of stuff was it?
Great question, Colin. So in the beginning, it was all homeowners. And I noticed shortly after that the real estate agents that were in my office and around in the business didn't really like working with investors. And I always thought, wow, there's a good opportunity there. There's a good business there. I wound up doing 75 to 80% of my business was all investor-based business over the years. So I grew a team. The team sold 125 listings a year. So we became very active in the marketplace.
And was that a mixture of homes that you bought and fixed up, and just some other listings you had from people that wanted to sell their home?
No, that was all retail business for my clients. Yeah.
Okay.
That wasn't any of my own business, right?
Okay, so were you still doing both then at the time?
Still doing both, as in
doing the fix and flips and also acting as an investor-friendly kind of agent broker?
Yeah, mostly an investor-friendly agent. I did do some fix and flips. At one point, wound up owning about 140 single-family properties.
Oh, wow.
So we did a lot of fix and hold. We
did a lot of buy and hold, yeah.
Did a lot of buy and hold.
And this is back in the 90s. I mean, how did you manage? I mean, what were most of those financed by? Because interest rates were a bit higher. Were they back then? I mean, was it credit unions, or what kind of stuff was going on then for big buy and hold guys?
Portfolio financing, a lot of owner financing.
Gotcha.
So I'm a big creative financing guy, and a lot of that residential stuff back then, it was really, there were a lot of opportunities for owner to assume mortgages or to quietly assume mortgages, owners to hold paper. So very interesting ability to do that back then. Matter of fact, the first real estate deal I ever bought was a owner finance 4-unit in the suburb of Chicago.
Perfect. Owner finance for you. Yeah, I've never done it myself, owner financing. I mean, I'm fascinated by the whole concept. I know people have been doing it for a very long time. It's nothing new. Yeah. And I mean, were they throwing off a lot of cash back then? Was it very profitable, or were we dealing with a lot of maintenance and evictions? Or, I mean, I'm not sure what kind of, were they easy to manage, or were they a little rougher than what you'd be comfortable with nowadays?
I think it's pretty normal. It's still pretty normal with the difference in the environment. Back then people were, you had home ownership that was, below 82%, below 67%. And, it was a good environment. So you had opportunity for rentals. You had opportunity for owner finance deals where we would buy a property and then turn around and put a tenant in there and sell it to them, owner finance. So we did some master leases, different, programs like that. But I can remember having a pretty solid overall occupancy rate where we, there was not a lot of empty properties at that time.
And how did you find out who taught you about all this stuff, or how did you learn it? Because it's not like you can just go to biggerpockets.com and type in, master leases and lease sandwiches and creative financing. I mean, how did you figure out all that stuff back then in your market?
It's a great question. There used to be a trainer called Robert Allen, wrote a book called No Money Down. This is years ago. And his big claim to fame was he made a deal with a newspaper that they could drop him in any city in the country, give him $20, take his wallet on a Friday, and by the end of the weekend, he will have bought 4 pieces of property and have $100 in his pocket. And he did it. and as a result of that, he wrote a book called No Money Down, which was about creative financing. I think it's a great book, and people could read that today still, and the principles, the techniques still work. But, I went to a 1-day free event, listened to that, wound up buying the weekend event. My wife and I at the time went to that event. We learned a bunch, left there. Monday morning, I start scanning the newspaper. By Monday night, I had my first property.
Wow.
And it was that 4 unit I told you about, that first deal I ever bought, creative financing. So
that's amazing. So you scaled that up pretty big. You were kind of coasting along as you're earning money in a couple of different ways. You had a very significant portfolio that was presumably, you're paying down that equity over time. Real estate was doing well in the mid to late 90s. So how did that transition? What was the next thing as you get into the late 90s and early 2000s? There was a big stock market crash and real estate wobble in 2001, right?
Yeah. Well, 2001, when all of that went on, I had a pretty solid, strong foundation. I was still, I had gone back and started to do some construction work as well. So I had a small contracting company again, where we were doing pretty well on the construction side as well as on the real estate side. So 2001 was pretty easy to glide through for me. I didn't have a lot of dips, and I certainly didn't have any high peaks, but it was a pretty even, set of years. And this is back, I was selling 125, 120 single family residences per year, and the investor market was strong. So there were a lot of opportunities for investors to buy off-market deals and buy, foreclosures and that, where they were able to go in, rehab them, and we were turning them around.
And you still had a decent personal portfolio at this stage as well, residential portfolio?
Yeah, I had started to wean off my personal portfolio a few years, probably 99, 2001, 99, 2000, we started to wean down that personal portfolio, and we sold off a huge amount of it. Because we knew that the market was going to soften. We were kind of seeing a peak, and a lot of it we sold off at a very good time.
That's great. So how did you, I'm curious because I've met a few people that have wound down big portfolios in the last 10 years. Did you sell them all kind of one by one, or did you try and sell them as packages to another large buyer?
Yeah, great question. So we sold off a bunch of bulk deals, a dozen here, 5 here. But we sold most of them one-offs.
Okay. And did you just sell them, or were we doing like a 1031 exchange into something else?
Yeah, we just sold them. We did a couple 1031s, but we just sold them. Yeah.
Okay. So you're quite liquid then at this stage, presumably, and you're still earning money from the investor sales, 120 plus a year. So what did you transition into next in the early 2000s? What was next for your career?
So 2005 came around, and I was clipping along, selling a lot of residential properties, had really liquidated our portfolio down to, I think we had 60 properties left. And they were, those properties that we had left that were 60 were small multifamily deals. I really like small multifamily.
Like 2 to 4 units, or, under 12
2
units?
8 unit, 2 to 10 unit deals, right. And so we were sitting on a bunch of those, but 2005, I noticed that the market was softening again, and that there was going to be some changes. And I had always wanted to go in the apartment business. So I thought, this market is going to hit a wall. We were at a peak level. I said, let's go do something different. So my listing partner and I, we went and started an apartment syndication company. And I went out and syndicated my first apartment deal. It was a small 11 unit deal.
Okay.
I raised $200,000 to do that deal off a little ad I put in the newspaper. So this is how long ago this was. I put an ad in the paper that said real estate investors wanted, and my phone rang off the hook all weekend.
No
And I
kidding.
found a couple of investors that put up the capital. We bought an 11 unit deal. And from there, we scaled to raise $18 million in the next 30 months and bought 4,000 apartments in 5 different states.
Oh my God.
It's about a $60 million portfolio. My biggest footprint was in the Dallas-Fort Worth market. I also owned several units in the Ohio Valley and then in northern Alabama.
It's amazing. And was this a mixture of accredited investor money and just kind of mom and pop non-accredited investor money?
I started out as, friends and family,
Sure.
not creds, got into the accredited investor money, and then we ultimately did some institutional deals.
So just for listeners that don't know, accredited investor money is, can you remind us of, is it that you need to earn about 200,000 a year or 300,000 with a married couple, and then you need a net worth of over $1 million and so on?
Not including the personal residence, right?
Mhm.
Yeah.
So kind of, considered to be sophisticated investors that can afford to do riskier deals, and you don't need kind of, certain licenses to do it. So even, were you allowed to put like an ad in the newspaper back then to like say who wants to invest in money, or is that just kind of a gray area back then? It wasn't as strict as it might be now.
Yeah. You weren't allowed to put an ad in the newspaper to raise money. And I guess I kind of walk a gray line there because I said real estate investors want. So
Right.
it was open-ended, right? And I only did it one time, just that one ad. But it was amazing what happened. I had a database of about 250 people.
Mm-hmm.
And I started to email market to that database.
Mm-hmm.
And what I did was I had seminars in my office. So on Tuesday and Thursday every week for 2 years, I would put 20 brand new faces in my conference room. And we taught how to invest in real estate. There's a book written by Gary Keller called The Millionaire Real Estate Investor. Probably one of the
Great
best
book.
Say it again.
It's a great book. Yeah, I recommend it.
Probably one of the best books I've ever read. And I used to teach that book. So I would advertise, come to the seminar, get a free book, and I give away cases of that book. And I taught the principles and the systems and strategies from that book so that when at the end, I would say, hey, and by the way, we're offering this apartment deal. So I always had a multifamily deal that I was offering. And people started to want to get involved. So we raised money that way. And then it's a big referral business. So, Uncle Charlie tells Aunt Susie and Tina tells Stanley, and, people become involved in the business. And it's interesting because, they're looking for alternatives to the stock market.
Because this is 2005 and 6, and it was just crazy time all over America and all over Europe as well, to be honest with you. Prices were going up 20% a year. Everybody was investing in real estate. Doesn't matter if you're a taxi driver, a hairdresser, I mean, whatever you want. People were buying rentals, upgrading their houses, borrowing money left, right, and center. I mean, and yeah, it's no different than the apartment syndication space, I guess. I mean, what kind of investors were you dealing with, and what was the typical investment? Was it like 10,000? Was it 50,000?
Yeah, the typical investment was 50,000.
Okay.
All the investors were, working class people, right?
Right.
You'd be surprised how many working class people are actually accredited investors.
No kidding.
In the beginning, we started out, most of our investors were non-accreds. We operated in the blue sky arena where you could do so many deals or raise so much money or have so many non-accredited investors in a deal.
Mm-hmm.
And so we always maxed out on our non-accreds on a deal and had some accredited investors in them as well.
Mm-hmm. Mm-hmm. So you mean, when you say blue collar accredited, you mean like it might be a guy like a plumber running a plumbing company who's just making good money, or what kind of stuff do you mean?
Yeah, working class is how I put that. When I talk about blue, I mentioned blue sky. which is the exemption, right? That's the
Gotcha.
exemption where you don't have to do a Reg D offering. So
So you must have had a pretty big team. I mean, you're talking, what'd you say, 4,000 units in a short amount of time? And did you just have, obviously these are all, what were the apartment sizes? Were they big enough to have their own self-management teams in place for them all?
yeah, it's a great question. So I had 138 employees.
Wow.
First deal I did was 11 units. The next one was 64, went to 87. Then it was 150 plus after that. I was
It's
buying,
amazing.
250, 350, 400 unit complexes.
That's just a pretty impressive trajectory. And you're basically using your own and the investor money for the down payments and then borrowing like commercial loans.
Yeah.
These are kind of balloon like 5-10 year loans over, amortize over 15-20 years kind of thing.
Yeah. So a couple challenges along the way, right, Colin? So one of the things was that we didn't raise enough money. $18 million might seem like a lot of money and a big raise, but when you buy $60 million worth of real estate, simple math says that we put 15% down average on those deals.
Mm-hmm.
So we were over leveraged. I would never advise anybody to put 10 or 15% down on a real estate deal today. You should be 25 to 30% into that deal, because that will save you a lot of heartache along the way, because you wind up with challenges, especially if your occupancy gets out of rate. So apartments, we know apartments operate pretty well at about an 82% occupancy rate. You go below that, you start to have some issues. You go above that, you're in a profitability zone. So, we had occupancy. We would buy deals that were about 78% occupied. We'd drive them up to 87, 90% occupied.
Great.
And they operated great there. We were in a profitability zone. Investors made money. Everything was well. Then the market hit a wall in 2008. And when that happened, people moved out. Occupancies dropped back 70, 60%. We had occupancies drop. I'll give you a quick example. I had a deal in Anderson, Indiana. When we bought that property, it was the number one city in the country to raise a family in. And we bought it, and within 9 months, it became the bottom of the list. It was the worst city in the country to live in. All the businesses closed up. People moved out. I had a property manager call me up on a Monday morning in tears, saying, "Hey, I just got to the office. I've got 32 moving trucks in the parking lot. I don't have a scheduled move out for 40 days. And those are the types of things that were happening in these, C class, B class deals. And, the working class people lost their jobs, income went down, and they wound up moving out.
And even, people that might have been paying, like you say, $1,200 rent in a nice community are moving to something a lot scruffier for half the amount, because they just can't afford the nice apartment with the nice tennis courts and all the rest of it anymore.
Right.
So that's, people, I talk a lot about people that lost money with rental portfolios and single family home portfolios. It was pretty rough for those guys back then, but the finance situation for people with thousands of apartments was worse. I think, that must have been horrendous for your cash flow. What happened?
Well, we wound up imploding. So, all of this was going on. I remember sitting at lunch in 2008 with my CFO, and we were watching the news and watching people carry boxes out of Lehman Brothers. And I looked at my CFO and I said, "Man, we're in big trouble, aren't we?" And I didn't say it that nicely. He goes, "Yeah, we're in big trouble." And, it was just one bad thing after another that happened for the next several months. In 2010, we imploded. And as a result of being over leveraged, not raising enough money, we couldn't keep things afloat. We had properties that should have just went to foreclosure, and investors that should have got, just lost their money. But I tried to save the whole company. because I had profitable companies that were operating really well and non-profitable companies. I started to move money back and forth between
I mean,
companies.
each LLC had its own asset, and so this LLC owns 150 units in Indiana. This LLC owns 90 units in Houston, and some of them were doing okay, and some of them were doing terribly.
Right, exactly. And so all of a sudden we hit this wall and couldn't function, and had to start moving money back and forth between properties.
Yeah.
And as a result of that, I made some bad business decisions, some bad business mistakes, and wound up being indicted on wire fraud and mail fraud charges and for non-disclosure. So I moved money back and forth between companies. And that's not the problem, Colin. The problem was I didn't tell my investors. If I would have told you that I was doing that and you would have said yes and signed the documents, we'd have been fine.
Yeah.
But I figured that the market would bounce back, that we wouldn't have a 40% correction in the market, that it would bounce back and we'd be able to fix everything. And that wasn't the case. So
these weren't necessarily common ownership in these LLCs. They were owned by different types of shareholders. It's not like you have a big company with a board of directors and there's tons of subsidiaries where you can move money around to keep them all afloat. Your situation was a lot. You needed to be a lot more careful.
Absolutely.
That's rough. I can see you're trying to do the right thing to try and keep the group afloat, but by not disclosing to investors that you're moving money back and forth, that's really okay. So yeah, moving money back and forth, Mike, as you said, is not a bad business strategy necessarily, but you needed to get permission from the shareholders of those LLCs, and that from what I know about you, that ended up being a catastrophic decision, right?
Yeah. So, there were some tough choices along the way, Colin. Like I said, moving money back and forth between companies, business owners do that all the time. Cover payroll, cover these bills, cover these expenses, put the money back. That's not the problem. The problem was that I didn't tell my investors, right? But what led up to that, I think, were a lot of the business mistakes, right? The being over leveraged, paying too much for properties, bad operations. I was the face of the business. I was out raising money and looking at deals and really building the company. And what would happen is we'd buy a company, we'd buy a property, build a business plan for it. I'd hand it off to the operations side, and thinking that they were doing all the rehabs and changing things and making things better. And, I buried my head in the sand and didn't pay attention to what was really going on. I take full responsibility for everything that happened, but I could have operated the business side of it a little bit differently than I did. And, as a result of that, caused these issues. And I wound up going to prison and spending some time. We lost everything. We had turned all the companies over to a receiver to run them, operate them, and ultimately about 50% of them wound up being sold off. And, over time, I think the receiver actually sold the last deal in 2018. So, the investors did okay, didn't totally get,
they got some of it back. Yeah, depending on where the real estate was.
Yeah.
Wow, that's a hell of a price you paid. So how long were you in prison, if you don't mind me asking, Mike?
Yeah, no, it's a good question, fair question. I was gone for 7.5 years.
Wow.
And then spent about 10 months on home confinement. But Colin, you go to prison and it's a pretty dark place, and it's pretty ugly. You hear a lot of stories, but half the stories you hear aren't true because it's worse when you get there. And I just tell that because when you're in prison, there's a saying that says you have a choice. You can either do the time or allow the time to do you. And I had made a decision that I was going to do the time, that I wasn't going to let it beat me. I wasn't going to let the system beat me. But I was probably there about a month and walked into the gym one day, and this guy said to me, he said, "Listen, don't let these people beat you." He said, "Get that 10 years back." He goes, "Come to the gym, work on yourself emotionally, mentally, physically, uh, and you will get that 10 years back." And he was right. I think I came home, Colin, in a better place physically, mentally, spiritually, emotionally than I'd ever been. And today I'm working on the finances. But, when you talk about the goal setting, but here's what I did. I was gone. I went to college. I got a bachelor's degree in theology. I wrote 2 books. I wrote a couple of home study courses, one on multifamily investing, one on property management. I wrote an ethics course. I taught school for 4.5 years. I taught Bible studies. I was on an outreach program where I would go into the community and tell my story to local business owners and the college students in the area.
Okay.
Did that about 40 times. I wrote a paper, a joint co-authored a paper with a professor from the University of Minnesota that we just had published in the Business Journal of Ethics. It was a case study on my case. It was an ethical dilemma situation.
Wow.
And if we have a second, I'll tell you the story that led up to that. And this is what I say: people need to make choices and decisions that are ethical, and we're faced with choices every day. But I was in 2010. I was walking into a board meeting, and I had a board of advisors. It was 12 men and women who were a lot smarter than me, Colin. And over the years, they really gave me some great advice about helping build my syndication company and multifamily operations. And I'm walking into this board meeting, and I met in the parking lot by my in-house legal counsel. And I was prepared to go in and talk to them about the loss of income, the loss of occupancy, the upside down of some of the properties, some challenges we were having, how we were moving money. And my attorney said, "Don't talk about any of that." And I was like, "Why?" He said, "Because we don't have enough information." I said, "Well, we have enough information because we're actually doing these things, but and this is what's going on." He goes, "Yeah, but we need to look at the market, see what's going." I let him talk me out of a decision that I knew would have been a right decision, which was to go in, talk to these board of advisors, maybe get some advice that might have helped us, turn the company around or flip something around or do something different. But I let him talk me out of it, and we never met with them again after that because things just really imploded at that point. But as a business owner, as an entrepreneur, leading a company, innately what you need to do. What's smart choices and decisions. And when you make a choice or a decision opposite of that, it really throws things out of whack for you. So you really have to be cautious about the choices and the decisions that you do make.
I agree. And I think there's a cautionary tale here for any, especially any multifamily syndicators listening to this. The truth is we've been on a 10-year, 11-year boom in the multifamily space. There's a lot of people that have made millions and millions of dollars for themselves and their investors buying in multifamily from 2010 to now. And there'll come a time when things go south, when the trading conditions get a lot worse, and they're going to have to figure out a way to do the best they can. I mean, what advice do you have for people, multifamily syndicators, facing a bad market, the best way to extract themselves and without, doing as little damage as possible? What lessons have you learned that they might be able to apply?
Yeah, don't operate in a gray area. Operate totally in the white, right? And make sure that you're doing everything ethically and with integrity. Make sure that you're being totally transparent. Make sure that you're looking at the KPIs. Make sure you're looking at those key performance indicators on your property, on your operations. We own 4,000 units and manage 7,500 others. and you should have been looking at more reports, should have been looking at more data. The detail is in the data. And the more of that you get your arms on or around as an owner operator, the better you can run things. Don't bury your head in the sand. Don't look the other way, because it's not going to go away. It doesn't make the problem easier. Deal with the problem. Work towards straightening things out. And I say that because, I had probably 5 or 6 properties that we should have just let go to foreclosure, which about 30 investors would have got hurt. I thought, geez, I can't do that to people. That wasn't in my DNA. And so I tried to save everybody by doing what I did. And it just didn't work out. If something is in trouble, deal with the trouble. Don't try to put a Band-Aid on it. If you can't fix it, you need to let it go.
Yeah, that's good advice. And so kind of, I think, winding down, Mike, I mean, let's talk a bit about exit plans. And obviously you've had far more time than you need to think about things. And I've been guilty of in the past of working harder and harder and harder just to get bigger and bigger and bigger. And COVID, like many people, just forced me to slow down, think about what I want to do with the opportunities that real estate has given me. What's you have a unique take on that. What's your take on exit plans?
Yeah, great question, Colin. I appreciate you asking. So while I was gone, I wrote one of the books I wrote was Exit Plan. And what made me think about it was that over the years, I had spent hundreds of thousands of dollars on coaching and training and books and tapes and buying seminars and systems to always kind of leave empty, right? And finding out that everybody teaches you how to get in a deal, everybody teaches you how to buy a deal, operate a deal, but nobody teaches you how to get out of a deal. And so I thought, well, geez, I'm going to write a book called Exit Plan, and it's your complete guide to multifamily investing and why you need an exit plan before you buy.
Okay, so what kind of exit plans? Can you give us some examples of a typical multifamily exit plan, or a typical way somebody should be thinking if they're planning to invest, $100,000 or $200,000 over 10 years?
Yeah, so interesting, right? Exiting doesn't always mean, Colin, that you're selling off the deal. It doesn't mean that you're always getting out. There's other options. There's other alternatives. I always looked at it. We'd run a 10-year spread on an opportunity, right? So you're going to buy a property, you run a 10-year spread on it. There always seems to be a sweet spot somewhere 5 years, 6 years, 7 or 8 years, where your highest profitability point is. Why not do something at that point? Even if you want to hold that deal for 10 or 15 years, do something to recapitalize, do a financial event, pull capital out, bring a partner in. You can exit a deal, not losing all your control, still control the property, pull capital out, and be able to go do something else and still have the benefits of what that will throw off for you. I've done some exits where we have raised private equity early on, did a deal, kind of re-engineered the deal, then brought institutional money in and taken out our private investors and continued to own and operated the deal with the institutional partner. So there's different ways to look at things. I'm going to leave the rest for the listeners to go get a free download of the book and read it.
I'll put that on the show notes. They can just go to a link and type in their name and they'll get a PDF of the book. Is that it?
Yeah. So free ebook. You can go to mycoreintentions.com/exit plan and download a free copy of the book. And I encourage everybody to read it because I think that there's some good insights.
I'm sure there are. So what are your thoughts, before we wind down, Mike, what are your thoughts on the current market? I mean, we've been in a real estate boom, for the last 7-8 months that's, gives 2004 and 5 a run for its money in terms of the sheer acceleration going on. What's your thoughts on how long it'll last and what are smart people, investing their money in these days?
Yeah. So I wish I had a crystal ball, Colin, right?
Well, yeah, me too, mate. But yeah.
2005, I saw the market was softening and went and did something else, made some money for a few years. And then all of a sudden, I didn't see the effects of what was going to happen. And I wish I would have looked a little closer. But I just thought we were going to be on this commercial run and multifamily wasn't going to get hurt, right? I think today what we're looking at is we're looking at anybody who's big in the space, who owns a lot of units, that they're going to be okay. So your operator that has 5, 10, 20,000 units, they're going to be okay, I think, through this. But it's the little operator. It's the small operator that owns a few units. I'll give you an example. I have a buddy who owns 5 houses. And he came to me and said, hey, I'll discount all of these for you. And it was like a 30% discount. I said, that's great. But tell me about your tenants. He goes, oh, good question. 3 of the 5 tenants haven't paid rent in 10 months. So I think those are the types of things that we're going to see over the next few months. I could be wrong. People might withstand the storm. You know, the stimulus money that's out there, the forbearances on the mortgage.
I mean, it is a different economy. It's not the same thing happening again. It's totally different, but you can't keep going up forever either. But you might get another year out of it, or a year and a half. And you're right, certain sectors might just sail through the whole thing, and others might get a real kick in the nuts.
Yeah. So, you know, it's hard to tell right now, but I think there's going to be opportunity. I believe there's big opportunity in small multifamily flips in the next year or so. And we've been looking at doing some of those deals. So we're going to probably get back in the game here and be doing some small multifamily flips here. You know, deals that are 3 to 15 units in size, and we'll flip those in 15 to 18 months.
Yeah, I can see how that might work out. That's really awesome. Look, I really appreciate you sharing your story with us, Mike. It's quite a unique story. I mean, do you have any final thoughts for our listeners and how people can get in touch with you if they want?
Yeah, you know, think things through. You know, you had asked me a little bit ago about, you know, what people should be aware of. And I think that if you're an entrepreneur or CEO of a company and you're sitting on, or somebody in a leadership position, you're sitting on the fence and have to make a tough decision, go get some advice. Go talk to somebody who you trust, who's smarter than you, to help make hard decisions. Don't hang yourself out to dry and make tough decisions on your own, because I think that in a lot of cases, it kind of leads to challenges that are tough to navigate.
Yeah. Great advice. Well, look, thanks again for your time, Mike. I appreciate it. I'll put the link to your book on the show notes, and good luck.
Thanks, Colin. Thanks for having me on. I appreciate it.
My pleasure. There you go, folks. That was show 36 with Mike Morawski. Not your typical real estate podcast. I think you'll agree. You know, I think Mike hooked up with me on LinkedIn and requested a chat with me, and I had a chat with him and told me his story and asked me if he could come on the show and talk about it. He's very upfront about everything, and I said, yeah. I thought it was a fascinating story. I mean, you know, a lot of podcasts are all, you know, rags to riches and everything's doing great and we're looking forward to the future, and I made some mistakes in the past, but I'm doing great now. And this wasn't that story, although he has, you know, picked himself up very well, and he's doing some great coaching now, I understand, and he's got he's written some books and he's doing a lot of other things. So fair play to him. But yeah, it just goes to show that, you know, that real estate can be quite painful. I mean, I know a lot of us are grateful and making the most of this kind of 10, 12 year boom. But whenever that goes south, and it might not be for another 2, 3, 4 years, or it might be a minor dip. But, you know, you just need to be careful, and when you need to make those decisions about navigating yourself out of a crisis, I think his advice about getting other people's help to make those decisions is a fantastic piece of advice, and obviously one he wishes he had taken. And, you know, special lesson for people that are managing other people's money. There's a whole host of ways you can get in some deep trouble if you don't follow the rules exactly as you should be. I mean, pooling funds, moving them from one LLC to another, is obviously a big red flag, and you can get caught and get severely punished for it. So yeah, just be careful, do things by the book, be honest, be upfront, get help taking decisions. And look, I'm not saying things are going to go wrong. I think the real estate market is booming, and I think there's a good bit of runway left yet, but there's always going to be ups and downs, as any 10, 20, 30 year veteran will tell you. And when the tough times come, get some help in making those decisions. I think that is my major takeaway from today's conversation. And I hope you enjoyed it. Something a little different today. He's very, very upfront and candid, and clearly quite a smart guy. He had a very impressive real estate trajectory before the bad decisions that were made, and obviously a lot of people took bad decisions and lost millions of dollars of investors' money 10, 12 years ago. Most of them didn't get punished as severely as Mike did. Very few of them did. I appreciated chatting to him. I wish him the best. I'm sure he is doing some great stuff with his coaching. And thanks for tuning into the show. I appreciate it. Give it a rating or a review if you haven't done so yet. I'd like that. Scroll down on your phone and click the 5 stars and put in some comments if you're enjoying it. Check out the website, obviously, colininvestments.com. Very happy to schedule calls with people there. Planning to publish new content. And me personally, I've been keeping busy. I'm still purchasing property in the auctions. I've bought some stuff from wholesalers. I'm researching land flipping at the minute, which is very exciting, and I'm going to have a guest on to talk about that further soon. So I'm keeping super busy these days. I'm really enjoying it, in addition to the podcast, which is a lot of fun. That'll do it for me today. This is Colin Murphy signing out. Appreciate your attention, guys. All right, take care. Bye-bye.